everyone, and welcome to today's episode of Lyrapulse. I'm Bhakti, joined by Vikas here today, and we are diving into a topic that's stirred quite a bit of interest in the consulting world: KPMG's Project Himalaya. From bold plans of cross-border integration to a surprising shift in the strategy, this initiative reflects broader changes in the professional services space. Let's break down what really happened and what it could mean for the industry. Vikas, want to kick things off here?
Sure, Bhakti. From what I have gathered, Project Himalaya was a pretty ambitious initiative. It was essentially an attempt to merge the consulting, risk, and advisory practices of KPMG in India with the counterparts in the US and the UK. The aim was to create a powerhouse advisory entity, especially leveraging the talent and growth potential we have here in India.
That's right, Vikas, and the numbers being thrown around were quite significant. We're talking about a combined workforce potentially exceeding 50,000 people and generating over $1 billion in revenue just from the India based platforms. It sounded like a game changer in terms of their advisory capabilities.
It was positioned as a way for KPMG to really scale up its advisory practice in India and compete more directly with other big four firms who have been aggressively growing the consulting arms. The idea was that by combining forces, they could offer better service levels to cross-border clients and access a wider pool of talent and resources.
And the timing of this was interesting too, wasn't it? It came after EY's attempt to globally split its audit and consulting practices, Project Everest, ultimately fell through. It made you wonder if Project Himalaya was KPMG's way of addressing similar market pressures and opportunities in consulting space.
Definitely. There's been a lot of scrutiny on the potential conflicts of interest arising from the traditional Big Four model of offering both audit and consulting services. While Project Himalaya wasn't a full split, it felt like a strategic move to strengthen their advisory side and perhaps create more operational efficiency.
I recall reading that KPMG India has been experiencing significant growth, especially in technology consulting and the services. So it made sense that US and UK firms would want to tap into that momentum and talent pool here. India has become a major hub for global capability centers, and the quality of talent in areas like tech consulting is highly valued.
Exactly. The India practice was apparently one of the fastest growing within the entire KPMG network. So, from the perspective of KPMG US and UK, it was likely seen as a strategic imperative to integrate more closely with the Indian operations to enhance their global delivery capabilities and potentially achieve cost efficiencies as well.
However, the last news seems to indicate a shift in strategy, right? Instead of full merger of advisory practices, there was a divestiture of significant stake in KPMG's global services to US UK entities.
Yes, that was quite a development. Earlier this year, we saw reports that KPMG US and UK jointly acquired a 33% stake in KGS for a substantial sum. KGS, as we know, is the global delivery arm that provides backend support services to KPMG member firms worldwide.
So, it seems like instead of merging the front end delivery practices, the focus shifted to consolidating control over global delivery center in India. This is a significant change from the initial vision of Project Himalaya.
It is, and the rationale behind this shift is quite interesting. Some reports suggest that there were any internal debates within the KPMG India partnership regarding the long term implications of ceding control over a key growth engine like KGS. While the stake sale provided a short term financial boost for the Indian partners, there were concerns about losing out on future revenue from global projects that run out of India.
That makes sense. KGS has been a crucial part of KPMG's global operations, and the Indian partnership managing it held significant influence. Giving up a majority stake to the overseas entities would naturally raise the questions about future control and revenue streams.
On the other hand, the immediate benefit of KPMG India was the influx of funds from the stake sale. This was reportedly intended to boost partner compensation, create a new pool of partners, and invest in scaling up their capabilities to compete more effectively with other big four firms who have been aggressively expanding their advisory practices in India.
So it seems like a strategic trade off. A short term financial gain for potentially more long term strategic alignment and control for the global KPMG network over its delivery arm in India. It also suggests that perhaps the complexities of fully merging the advisory practices across three different geographies proved to be more challenging than initially anticipated.
Exactly. Cross-border mergers of professional services firms can be incredibly intricate, involving different regulatory frameworks, partnership structures, and cultural nuances. Perhaps the stake acquisition in KGS was seen as a more pragmatic and achievable step towards closer integration and efficiency.
It also highlights the growing importance and value of global capability centers in India for the Big Four firms. These centers provide crucial back-end support and increasingly front-end capabilities to the global operation. The competition for talent and strategic importance of these centers are only going to intensify.
Absolutely. And the fact that this is the first divestiture of a Big Four captive in India is quite telling. It signifies a significant potential shift in how these global networks are structuring their operations and leveraging their India based capabilities. It will be interesting to see if other firms will follow a similar path in the future.
So, while Project Himalaya in its initial form of full advisory merger might not have come to fruition, it seems to have evolved into a significant restructuring of KPMG's global delivery model, with a clear consolidation of control over KGS by the US and UK firms. The long term impact of this KPMG's competitive positioning in India and globally remains to be seen.
Agreed, Bhakti. It's a complex situation with both potential benefits and drawbacks for the different entities involved. We'll definitely need to keep a close watch on how this unfolds and how it influences the broader landscape of professional services.